Let's talk about how to lower or eliminate your capital gains taxes on your investments. Most portfolios are designed, as they should be, first based upon risk and then based upon total return. The trouble is we're not looking really for total gross return, we're looking for net return. Net of fees, net of taxes, how much money goes into your pocket. So let me give you a few examples here. If we have a portfolio that's paying a 10% return, or it's making 10% a year annualized, but it's very inefficient tax-wise. We're paying income taxes, short-term capital gains taxes, which are taxed at income rates, then for the average high net worth investor, we're probably talking about a 6, maybe 7% net return. So here we are taking the risk of a 10% returning type portfolio to net 6 or 7, not a whole lot more than a tax-free bond would with very little risk. So what we need to look at is net of taxes, how the portfolio is performing. Now in an IRA, this doesn't matter. The trouble is most portfolios are designed without any regard to the tax sensitivity. Some portfolios are very tax efficient, some are very inefficient tax-wise. One of the things that I've seen that's really a big mistake is a portfolio where the client has an IRA and they have a non-IRA, and the non-IRA has things in it like maybe corporate bonds or real estate trusts that are spinning out income taxes. And over here in the IRA, they have assets that would spin out capital gains or dividends, which are taxed at a much lower rate. And so when we look at these, if we were to just switch those two buckets around, that one thing alone would lower the taxes. Now let's go over here. Now that we know that in our non-IRA accounts, we want to have tax-efficient investments, because there are growth mutual funds that are tax effective, and then there are ones that are inefficient, and then there are tax growth funds that are very tax effective and are tax efficient. We want to invest in, whether it be mutual funds or exchange traded funds. When we're looking at what to invest in, we have to look at how long we're going to hold it. We want to look at what the capital gains exposure is, what the turnover is. So for example, if you have two mutual funds that both have equal risk and equal return, and one has high turnover, meaning it's buying and selling its stocks more often than the other, it's going to spin out more short and long-term capital gains, meaning you're going to get a 1099 for a bigger number, meaning you're going to lose more of your return to taxes. Or what's worse is you'll be paying someone else's taxes. This happens all the time with mutual funds, and most investors are oblivious to it until they get stuck with the bomb. So the tax bomb, I should say. So let's say that you invest in a mutual fund that bought Google at $50 a share. And that mutual fund holds Google, and now it's worth $100 a share. And now that mutual fund's done well, so you buy it. And Google goes down to $80 a share. Now you're down 20%. But the mutual fund sells Google, and the mutual fund made $30 a share, so it spins out a capital gain for $30 in profits on Google. And even though you lost money, you got a 1099. Now just imagine if your neighbor sold his property and he made $100,000, and you got a 1099 that says you owe taxes, even though you're sitting there in your house that you paid for that's worth less than you paid for it, and you get a 1099. Because your neighbor made money on his property down the street. That's exactly the concept of what happens in mutual funds for many investors. Look at the turnover ratio in a mutual fund. Look at the capital gains exposure. In best case, find a good mutual fund. If you're going to be investing in mutual funds, which are for a lot of people good investments, look for an investment that potentially has embedded capital losses, so that it probably is not going to spin out a capital gain for many, many years. There are a lot of those investments out there in the mutual fund world. And for those that are more sensitive tax-wise in a higher tax bracket, look at separately managed accounts where they can do tax loss harvesting for you. A mutual fund has thousands or hundreds of thousands of investors in most cases, and they're not managing the taxes for you. They're managing the portfolio for pension holders, 401k owners, joint account owners, and if you're a joint account owner, they're not managing it with any regard per se to taxes. So as you look at your portfolio and you're getting 1099s and you're paying capital gains and dividend taxes, look for a portfolio that's separately managed where they can harvest the losses. Let's say you have 200 holdings in a separately managed account. 10 of them lose money and 190 of them make money. A separately managed account has the ability to sell the 10 losers, give you a tax loss for that year even though you made money. Now, a mutual fund can't do that. If a mutual fund has 200 stocks that and 190 of them make money and 10 lose money, you're in all likelihood, if they have any kind of turnover, you're going to have some capital losses. So look at how long you're holding investments. 366 days is taxed different than if you hold 364 days. Mutual funds are taxed different from exchange-traded funds. Some mutual funds are taxed different than others because of their embedded losses, because of their capital gains exposure, because of their turnover ratio. Look at these factors because your CPA in almost all likelihood is not looking at these factors and paying attention. They're just taking your 1099, putting them on your tax return, and you're paying the taxes. That need not be the case. It's one of the extra ways. It's just one more way that you're leaking money in the bucket, and we need to plug that hole. Manage your portfolio with regard to tax sensitivity.